You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
All right, ladies and gentlemen, today's guest is Ashtons Levarek. I'm always tearing last names up. But he's a veteran-owned and operated multifamily investment group focused on creating cash flow, passive income, tax-free wealth, and a life where they don't need a vacation from. So something you love doing. They purchase apartment complexes and focus on forcing appreciation by adding value. They primarily buy multifamily buildings built in the last 30 years that is in need of TLC and allows them to add a lot of value opportunity to it. Ashton, man, thanks for coming on today. How you doing today, man?
Great. Thank you for having me. I appreciate it. Good,
man. So obviously that was a short bio and there's a lot more to you. Tell us a little bit more about who you are.
We're multifamily investors. My brother and I partnered in 2008 to start growing our passive income because we both had 9-to-5 jobs. Our wives had 9-to-5 jobs. And when you started having kids, you want to spend more time at home. And we just didn't see that happening with our jobs. So I'm full-time active duty military right now. But I should be retiring here in May. So I'm looking for, a little more family time, not starting another job, which is typically what happens, right? Because you can't recoup that retirement, even if you did 20 years, you can't recoup that retirement until, age 60. So if I wanted to start a whole nother job, I could. But, the way we saw it, creating multiple streams of income from rentals made a lot more sense. And so we started out with a couple duplexes, a quad, 5-plex, 13 unit, and started working our way up. And we're pretty young in it, but we've been hitting it hard as far as, time in. We've only been doing this for about almost 2 years now. So, but we learned everything we could and just started making offers and hustling and growing our brand and, reaching out to everybody around us to, go bigger and bigger and start working with as many people as we could. So,
Right. That's cool, man. Cool. Very, very good story there. So, why did you decide to go with multifamily versus like mobile home parks or self-storage? Like, what was it about multifamily that made you want to jump in it?
Well, initially, I didn't even know about, I had no idea about mobile home parks, self-storage. I know there's a lot of other ways to invest. And to be fair, through most of my career, and this is kind of a knock on me, I never really looked to the future. I just wanted to be the best, the best operator that I could in the military. And I worked really hard at that. And, they tell you to put money away in the thrift savings plan, they call it the TSP in the military. Yeah. But really, that doesn't do much for you. It wasn't until about 2016 when I was overseas and I ran into this guy. He was lower ranking than me. He was a helicopter medic. I think he'd been in the military maybe like 7 or 10 years. And he was talking about making this cash flow every month. And I was like, what are you talking about? And he, dove into how everywhere he got stationed, he would buy a duplex or a triplex or a quad and then rent it out. So basically house hacking. Right. I had no idea what he was talking about, but it sounded like, it sounded smart. So I wrote down everything he said. And this is funny because we're sitting underneath the helicopter, sitting on the desert, waiting to go do something. Right. Sitting out in the desert. And it's just two of us, just making small talk.
Talking about real estate.
Yeah. And then, man, he started saying all this stuff. I'm like, it just started clicking. And I wrote it all down, but I didn't do anything to it, with it until, I didn't do anything until 2018 when my brother hit me up and he's like, hey, I'm tired of this 9-to-5 stuff. I just heard about this real estate investing.
Yeah.
And I was like, man, that rings a bell. And I started to look back at my notes, and I had all this written down. And so, so we started looking at that. And again, like, why did I pick multifamily? Well, I think it started with that guy talking about how you could scale that much faster.
Yeah.
And then also how it just made more sense. You know, when you take a vacancy on a single family, or you take a vacancy on, a single family, I mean, you're 100% loss there. You're paying out of pocket. So multifamily just made more sense. And then, like I think I said before, we got into the duplexes and then the quads, and we saw that, it's the same amount of work.
Yeah.
And then as you go bigger, it's still the same amount of work. It may take a little bit longer, to walk the property and to get the due diligence and do all that. It's really the same process. And so it just made more sense to us. Right. So, long story longer, that's basically why we went into multifamily.
Gotcha. That makes a lot of sense. So, now that you're in multifamily, like, what are you doing to find your deals? Like, how are you finding them?
Yeah. So, that was a big one for us starting out. Yeah. How do you find deals? And initially, you kind of go the traditional route. You start talking to brokers. Yeah. And it was a little tough at first because, we were pretty green in the industry. And so when you go to a broker and you tell them, like, hey, we'd like to buy, a small or even large multifamily property, they're kind of they'll add you to their list, they'll add you to their buyers list, and they'll start sending you deals, but I don't think they really pay attention to you. So really what helped for us was every time they sent us a deal, we would send them feedback. Yeah. So why this deal works, why it doesn't work, and what we're looking for. Yeah. So that was the first way we did it. And then we also started developing a lot of relationships in the industry, and to lean on, I think it's David Green's book, Long Distance Real Estate Investing. He says something in there, rock stars know rock stars. And if you build a good team and a good network, they're going to really help you out. So, I think that's really important for people starting out, is if they can get that network, if they can start building that team, it helps out so much. So we found, through Bigger Pockets, actually, we found a property manager that he just crushed it in Raleigh and Durham, which is where we operate. And then he started bringing us deals because he saw that, we could close and we were serious and we wanted to scale, and, it's good for him. It's good for us. So he started bringing us deals as well, from wholesalers, off market. And so it worked out really well. Right. And now we're starting to experiment with cold calling, getting, names and properties off of list source, and then looking up, LLC owners, and then cold calling. So that's probably going to be the next step here. Yeah. As we, because you want to keep that pipeline full, right? I mean, everybody, if you don't have a pipeline, you can't invest. So but that's kind of going to be our next focus as far as finding properties. Yeah. So, you said you started about 2018. So the biggest challenge for you was what, when you initially said, all right, man, let's go ahead and figure out how to buy our first property. What was the biggest challenge you faced then? Knowing what was a good deal, I mean, because everything's for sale at the right price. Yeah. But if you buy it at the price that they're selling for it, it's probably not a great deal. Yeah. So it worked out really well. Hold on. Thank you, honey. It worked out really well. But because my brother him and I are both very competitive, but we're also very opposite. And when we decided to partner together, so he's very in the details. He's he's really systems oriented. He can be pretty risk averse at times, whereas I'm the absolute opposite. Like, I'm big picture, and I tend to jump in and build my parachute on the way down. And so, so it really helped because I started putting offers in on everything, but then he would kind of double check me, and we'd work back and forth and to find the right one. And even when we found the right one, there was still like a lot of unknowns. But I think what helped a lot was, again, developing those relationships. So, we started talking to a lot of people, and they really helped us out in growing and finding that first deal. But yeah, in trying to find that first deal, I think, action. You gotta start taking action, whether that's just researching the market or actually putting in offers. Like, you decide where you need to be. But
right.
I think that's the big one, because once you start taking action, it just makes everything else easier, and you'll find out what you need to do next.
Right. So I want to ask you something here. A lot of people say you don't mix family and business together, but it seems like you guys have figured out the way to put this together. So, I mean, have you guys kind of set some parameters on, hey, this is your role, this is my role, this is what we're trying to do? Like, what are you guys doing to help you with that?
Absolutely. So, initially, well, let me back up. My brother and I have been pretty close for a long time, so that definitely helps. But I mean, nothing can ruin a relationship faster than money, right? So if everything's money based, you're playing with fire there, whether it's family or friends or whatever.
Right.
But I think where we started was probably key. So we started with an idea that we don't want to be working 9 to 5. We want more freedom.
Yeah.
And so every decision we made was based off of that end goal. So like, how do we create more freedom in our life? How do we create more time? Time's a big one, right? Everybody wants more time.
Right.
And so we started with that in mind. And it slowly morphed into more defined roles. And that was largely due to my brother. I mean, I have to take my hat off to him. He was, like I said, he got into those details, and he's like, hey, we need to talk to a lawyer. We need to, set this up like an actual business. And so that's what we did. We didn't know what we were good at just right away, as far as real estate investing,
Right.
But as we put down the legal parameters first, and where we wanted to be, and where we want our business to go.
Yeah.
Then we actually heard about doing personality tests.
Yeah.
Yeah. And I've actually done a couple of those, going in my job in the military, and I never really thought much of them. But when somebody else said they were doing them for their business, and they do them with everybody they hire, that kind of just made sense. And so we went with Tony Robbins used the DISC profile. Not sure if you heard that one.
Yep.
Yeah. Yep. So we did that. We did the DISC profile, and that's when we found out we were completely opposite. Which
so let me guess, you're a high D.
I am. Yeah. High D, high I. And then my brother is the exact opposite. So it worked out really well. And as that kind of morphed, we started to see that, he's going to be more like the operations manager, more of the systems and in the background, and making sure everything runs smoothly. And it's perfect. Like, that should have occurred to us at the beginning, but it didn't. Sometimes you need something to click for you to help you wake up in that sense. But so he is, he's an IT manager right now. So he's in, information technology. So he knows a lot of the applications to use and to make a business run smoother.
Right.
And so he automatically kind of just fell into that and just started bringing those applications to our business. And that helped out a lot.
Yeah.
Whereas on the flip side, I was out there, building our network, building our teams. I was making offers. I was finding properties. So it kind of just, we fell into those roles. And then as we did the personality test, and then as we, started seeing what worked and didn't work, then we really defined it. And so as it is now, he is, we're both owner managers of our business. Yeah. But he is, he's doing the operations side, and then I'm doing the acquisitions and networking. It really worked out that way. But if anybody, was looking for a clear answer, I think, you got to see what works. I mean, not everything's cut and dry. I think starting with a good personality test will help, though. Yeah.
That's a great tip. Really good tip. All right. So what markets are you focused on right now as far as investing in?
Currently we are focused on Raleigh and Durham, but we recently broke into the Raleigh-Durham, North Carolina, and then we recently broke into Fayetteville market as well. And when I say Raleigh-Durham and Fayetteville, we're also looking at the submarkets surrounding those, because the submarkets, you can get, Raleigh and Durham are very competitive right now, and maybe not as competitive as, say, like Phoenix or I don't know, some of those other ones like Las Vegas and stuff, but they are pretty competitive. And, there's a lot of out-of-state money coming in, and they're purchasing not for returns. They're purchasing more or cash flow. They're purchasing for lower returns than what we can do right now. So those submarkets tend to be a lot easier to break into, and I think you get a lot more for your money. So price versus rent, so. Yeah.
That's cool, man. Very good to know. So what is it about Fayetteville that you really like? I know that's a military town. So is it, you kind of banking on the military?
Yes and no. When we look at a market, and we really did look at a lot of markets around the country, trying to figure out where you want to start. We kept seeing, the top three parameters were, job growth, which drives population growth, which drives unemployment down, obviously.
Right.
So, and there's a bunch more factors you can look into, rental growth and rental market and all that as well. But those were the top three, and that's where we started. And as we looked at Raleigh and Durham, all those areas, support those metrics.
Yeah.
Whereas Fayetteville has a very strong renter market. It's 55% renters in Fayetteville. And it's supported by a huge industry, like you said, the military. That's not the only industry, but it's supported by a huge industry there. And not only is the military, Fayetteville or Fort Bragg is the biggest, military installation in the U.S. So to worry if that industry is going to go anywhere, I don't think so. And then I would also say, if you're familiar with investing in stocks, when people are worried about the market crashing, they start to invest in government-backed, bonds.
Yeah.
And I look at Fayetteville much like that. It's a government-backed economy. Everything from just the military that work there and supporting the economy there, to also the people that work on the base that are not actually in the military. So they support all that whole industry, that whole economy. So we know we have a strong renter base. Now, is it going to appreciate as fast as, say, Raleigh, Durham?
Yeah.
Probably not. But when you really look at where you stand to profit, and that's cash flow. And we're looking to create cash flow. So cash flow for us is monthly cash flow, monthly rents. And so when we look at a rental market, that's what makes sense.
Right.
We're not necessarily expecting it to grow as fast as Raleigh Durham, but we do expect it to be stable and remain consistent throughout the downturn, if and when, we all expect it to come. So.
Right. Now, what kind of cap rates are you seeing in Fayetteville right
now? So cap rates, we're looking at this last one, we're buying at 6.5, I think, to 7. So, you can really hunt those deals in Raleigh, Durham, but I think the submarkets in Fayetteville have been more promising for us. Yeah.
Oh, that's great. So when you're looking at a deal, what kind of unit size are you guys at right now? 'Cause I know you've been growing.
Yeah. So our biggest deal to date will be a 16 unit. And we're closing on that in January 15th, in fact.
Okay.
But, we are looking upwards. Yeah. So we're still kind of small, but we're looking right now for our next 20 to, 60 units. So, And really, I think what it comes down to is how much money you think you can raise to take these deals down. Right.
Right.
And that's just what dictates where we're at. I know we have the infrastructure. I know we have the infrastructure and the team to do it, to put it or put in place to actually take these down.
Yeah.
But as it is right now, you kind of base it off of your investors and how much capital you expect you can raise. So, But yeah, I think over the next 4 months, we're hoping to get another, 100 units under contract. So
that's great.
we're actually looking for that. Yeah, I got to actually make some cold calls after this, so it'll be fun.
Oh yeah. That's the best way to find them, man.
Yeah.
So when you're looking at your deals and your underwriting, I know your partner, he probably does a lot of that as well. But what are the biggest red flags that you kind of look for to say, this is not a deal for me?
So the biggest red flags are going to be, well, we start with criteria for. So let me back up. So we try to look at it. I try to look at about 100 properties a month, and I dive into, out of those 100, I'll knock out 70 of them real quick, just by, they're not in the right area. They're not the right class, as in like A, B, C class.
Yeah.
They're not the right year, because we're trying to keep it within 30 years just to keep the repairs and rehab.
Right.
Yeah. And there's a couple others, obviously, if it's out of our price range. So that knocks out a lot of them, because, you do get a lot of, once you start talking to more and more brokers, you're going to get a lot of deals sent to you. So you can't be diving deep into the numbers, doing the underwriting on every one. You're going to, waste a lot of time, lose your mind. But then, out of those 30, I'll start looking at them and I'll get back to the broker, and those will kind of self-eliminate, because the broker will come back, oh, that guy, they're asking, I don't know, 2 million. And I'm saying, well, it doesn't work for us until around 1.2. And the broker's like, well, he's definitely not going to negotiate that much. So those knock out a bunch more. Then we get into, say, maybe like 10 more of those I start really looking at. And I think this is where your question is leading. So, of the last 10, we start looking at, okay, where can we add value? Is there potential to raise the rents? Is there potential to decrease the expenses? And, we want to see, and really for us, it comes back on, cash on cash return, our internal rate of return, our average rate of return, that kind of thing. So if we can make it work, and I say make it in the sense that we know we can get the expenses down to below 40%. We know that we can raise the rents to create at least 9% cash on cash return. And get at least a 15%, 12 to 15% internal rate of return over the life of the asset. Then that is that's when we'll start writing up a letter of intent, or talk to the broker and make an offer. So does that make sense?
That makes a lot of sense. Makes a lot of sense, man. So I mean, what I want everybody to hear, he said he goes through 100 deals to maybe find 10 that could possibly work, and then he's going to dig a lot deeper into those and try to negotiate an opportunity. So you got to do a lot of hard work if you're going to find the good deals, man. So that's good that you're doing that, for sure. All right, man. So let's segue into the next segment of the show. It's a deal deep dive. Let's talk about a deal you've done. What did you see? What did you like about it? And what's the plan for it?
Okay, so we can go through our latest deal, because that's probably the one that's the freshest in my mind. So we recently got a 16-unit apartment complex. They're townhome style in Fayetteville. It's really, really nice area. It's like 5 minutes from the hospital, Cape Fear Hospital, which is the biggest hospital in the area. It's in a quiet neighborhood. It's 12 minutes from the base. So a really good area for renters. That's what we liked about it, as well as it was built in I want to say 97. So it's, as far as Class C properties go, it's a fairly recent one. What else do we like of it? Okay, so they're 2-bedroom, 2.5 bath, meaning it has 2 full bedrooms upstairs and 2 full baths, as well as a half bath downstairs, the kitchen obviously, and then a living room and a dining room. So it's perfect for like the starter family to the single, to a single renter to even roommates. So it works across a whole scale there of renters, which makes it more versatile and more likely to stay occupied, and that's good. That's how you decrease rents or decrease expenses. Excuse me.
Right.
So those were a couple things we liked about it. Also, the rents hadn't been raised. There was a lot of potential there. So I think we looked at potential rents being from 750 to 800. The current rents are, the lowest being 495 and the highest being 725.
Wow.
So the average there across all 16 came out to around 640, I believe it was.
Yeah.
So there was a lot of room to move.
Yeah.
So in the first year, we see that we can get at least all 16 up to 720 to 725 to 750 per unit. So that allows us the right amount of growth to allow us the right amount of returns. That was a big one we liked.
Right.
There was a lot of.
Let me pause you there. With that rent bump, what are you going to have to put into the units to add value? Is there anything like flooring or updated appliances, or is just raising it to market value?
Yeah, so that's a good question. And that's one of the things you kind of go back and forth, like how much do we have to do to get it to market value, right?
Right.
So I'll kind of back up to while we were doing our due diligence, we don't just go off of our numbers. Again, like this is not my expertise, that my expertise is meet people and jumping out of planes. But so for us, it was, we got our property manager involved. We got several, in fact, we interviewed several property managers and contractors, had them walk the property with us. And we got their opinions. And so with new flooring, new paint, some needed new appliances, and then there was quite a bit, and I'm going to say a lot of deferred maintenance that we just need to take care of. Mm-hmm. And by doing that, that'll help us be able to raise the rents. But, and when I say a lot of deferred maintenance, we're not talking huge stuff. It's just minor things really that just the past owner has let slip away. But it will justify that. It'll help justify that in the eyes of the renters, So siding repairs, gutter repairs, I said new paint, new flooring. Just some minor stuff. There's a lot of minor stuff that we can take care of. So we're looking at putting no more than, I believe it is $5,000 per unit into the property. So
that's reasonable.
For us, it's very fresh in our minds. Our first one, we put 20,000 into each unit.
God.
So, maybe that would have been a better deal, Deep. I don't know, because people tend to learn more on those hard ones. But it was a heavy lift for us. It worked out, but it was a heavy lift. And so with that one still fresh in our minds, we're kind of like, man, 5,000, that's really good. So, that was on our first quad. It still fell under the residential way of value. So the neighborhood saved it, and we ended up being able to refinance out. But the point is, so 5,000 per unit for this one, at the most, I think. Because some don't need as much as the others, which is really nice, right?
Right.
But some have been lived in for like the last 10 years and nothing's been done. And none of the rents haven't been raised either.
That is common, man. Especially when you run into the mom and pops, the rent is low, won't do any maintenance to it, and the tenant they almost look at it like it's their house, so they'll go in and start doing stuff themselves to it. It's crazy. But what kind of debt did you put on that? What was the purchase price, and what was the debt you put on it?
So initially he was asking 1.2 million, but we or 1.1, I think 1.1.
Yeah.
And we were able to negotiate down to 960,000.
Okay.
So so it's not
conventional loan then.
Yeah, so it's not going to be a Fannie Mae, Freddie Mac. It'll be recourse loan. So I believe it's a 20-year amortization with 4.25. So that helped out. But
now, are you guys planning to hold this long term, or are you going to sell it in maybe 3 to 5 years?
We're looking at refinancing in, I believe, 3 years, and then selling in 5 if the market supports it. Mm-hmm. So we have options there, obviously. But that is right now the business plan. So.
Gotcha. So your strategy right now is to pretty much find an opportunity to add value, refinance it, and then hold it for a little bit longer, and then sell it at the top of the market. Hypothetically
That's right.
speaking.
Yep, that's exactly right.
Gotcha. I mean, that's a great strategy. Really good strategy, man. That's what I plan on doing, and I'm also looking at, I like to hold as well. So, you can keep making money, but if you want to keep that generational wealth going, it's about buying and holding as well. So it's kind of like a mix of both. Really, is my ultimate strategy, man.
Yeah, I like that. I mean, we have a couple that we're holding a lot longer, but for this one, we're looking at a 5-year. Yeah.
Gotcha. All right, man. So let's segue into the last segment of the show. It's the lightning round. So I got a couple questions. You ready?
All right, let's do it.
All right. So what's the best advice you ever been given?
Take action. Massive action, or massive dreams require massive action. Yeah.
I love it. Simple, but yet powerful. All right. What is the best book you've read this year?
Oh, the best book I've read is actually called The Best Ever Apartment Syndication Book by Joe Fairless.
Yeah. I read it this year too. That's an awesome book.
Yeah, and I'd like to point out too. I mean, if there's people here that are either new or old to multifamily, or just dabbling in podcasts, and they found this one, I would just say that that book's not just good for multifamily. That's not just good for apartments. I mean, yes, he does outline all that, but he's really big on having a business plan going in, having a goal, having a 3-year goal, 1-year goal. And I think that's clutch. And if you don't have that, you don't know where you're going. If you don't know where you're going, you're probably going to get there.
Right. That's the truth. That's the truth, man. All right. So, what are some rituals you're doing right now to make you a better investor?
Well, I love that question. That's a great question because, my whole life has been revolved around that. Like, what do you do daily, right, to ensure excellence or achievement? Well, I'm huge on early mornings. My brother and I are both like this. I try to wake up around 4 to 4:30 in the morning. I try to get some silence in. I try to do a little reading, some journaling. I go over my goals and then what I want to do for the day. And I found that, that gives you clarity. Like, what am I focused on each and every day? And then what am I doing each and every day to do that, to get there? And it helps you sift out, the small stuff that you don't need to be doing. Yeah. And really focus on the big stuff. The what do they call that? The $10,000 an hour projects. Like, you want to make money or you want to be successful. Like, you got to get the most bang for your buck and spend the time wisely. So, for me, it's really that focus, starting early, getting that focus in. And especially if you have kids or another job, you got to do it early in the day. You have to, in my opinion. Yeah.
Gotcha, man. That's good. Some good points there. So what is the one thing you're doing right now to improve your business? Like, what's that one thing you're focusing
on? To improve our business, what is the one thing we are focused on? Well, for me personally, we're focused on this one project. So this 16 unit has been the primary focus for the past month. Yeah. So making sure that all our investors are taken care of, they have the understanding they need, and everything's set up for their success, for our success. Because if they're not comfortable, then we're not comfortable, and a deal won't work. Yeah. So we've been really focused on, using the right application, setting up the right systems, and making sure everybody's clear about what's going on with this deal, and so that we can have a smooth closing. That's been the biggest focus right now. Right. And again, I think it goes back to like really prioritizing. So this is our priority right now. So, that's why we're focused on this one thing. As far as our business as a whole, I mean, there's a lot of other things we could be doing, but this is the one thing right now. Right. And I forgot to ask you earlier, the 16 unit, you guys JV that deal? Was that a joint venture? No. This is our first official, apartment syndication. Yeah. We had a webinar, we raised the capital and everything, through friends and family and So, no, this is not a JV. Yeah. Okay. We have, just three partners. So my brother, me, and then one other individual. And then we syndicated the rest.
Gotcha.
Yeah.
All right. Last question for you.
Yes, sir.
If you can give your younger self one tip in regards to investing, what would it be?
One tip for my younger self would probably be start sooner. I really like that Chinese quote. The best time to plant a tree was 20 years ago.
Right.
The second best time is right now.
Yeah.
But yeah, I think that's what I would tell my younger self. Start sooner.
That's great, Ashton. Well, hey man, tell my listeners, how can they get in touch with you?
So my brother and I, Chris Levarek and Ashton Levarek, we're both on Bigger Pockets, but you can easily just reach out to us on we're also on Instagram and Facebook at Valkere Investment Group, or our website, valkeregroup.com, www.valkeregroup.com. And that's Valkere spelled Valkere group.com. But yeah, we're here to help. We love reaching out and talking to other investors. We love learning from other investors as well as helping other investors. So please feel free to reach out at any time. But it's been a pleasure being here. I appreciate it, Willie. Thank you.
Yes, sir. Hey, thank you, man.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.